Hello and welcome back. I wanted to go through the Chapter 2 practice problem. Basically what this is we're going to be preparing journal entries, and then we're going to post them to T accounts, and then we're going to prepare a trial balance. So let's start off here at the very beginning. We have Denzel Brooks, who opens a web consulting business called Venture Consultants and completes the following transactions in March. So, first thing, March 1st, Brooks invested $150,000 cash along with $22,000 in office equipment in the company. So I'm going to put down my date, March 1st. And he's putting cash into the company, so he's actually cutting the check himself, but it's not going to be cash coming out. He's actually putting money into the company, so we have to look at it from the company point of view. So I'm going to debit cash because I'm increasing my cash by $150,000. So this will be my debit column and my credit column. And he's also putting in office equipment worth $22,000. So I'm going to increase my office equipment by doing a debit. And I'm going to abbreviate here. And then the credit is going to go to the capital account because this is the net worth of Denzel Brooks' company. So that's going to be a total credit of $172,000. Okay. On March 2nd, the company invested $60,000 cash for 6 months rent for an office, and they give you a hint. Debit prepaid rent for $6,000. Now prepaid rent, that's one of those things that is actually something that you own because you've paid for it up front, so you own the right to occupy space. And because you own it, it is an asset, because assets are things that you own. So I'm going to debit prepaid rent for $6,000. And the credit says here we prepaid $6,000 cash. So I decrease cash by doing a credit for $6,000. On the 3rd of March, the company made credit purchases of office equipment for $3,000 and office supplies for $1,200. Payment is due within 10 days. So this is a credit purchase. So we're going to be talking about accounts payable, meaning that it will be paid sometime in the future, not right now, but sometime in the near future. That's what accounts payable means. Notice also we have a distinction, office equipment versus office supplies. These are not the same thing. Supplies and equipment are two different things. It's basically it's based on length of time, as in the life of the particular item. If it's going to be something that's going to be here today, gone tomorrow, that would be office supplies. We're talking paper, pencils, post-it notes, binder clips, things like that. Those are supplies. Office equipment would be like tables, chairs, computers, printers, copiers. Those are all office equipment. Those will be around for a lot longer than office supplies, which will be gone very quickly. So I'm going to debit office supplies to increase that. for $3,000. And I'm going to debit office supplies for $1,200. And again, it was made on a credit purchase, so I'm going to hit a credit towards accounts payable. And that will be for $4,200. Okay, on the 6th, of March, the company completed services for a client and immediately received $4,000 in cash. I'm going to pull out a ruler here to keep track of where I am. Okay, so we received cash immediately, so I'm going to debit cash to increase cash for $4,000 even. And I'm going to credit some sort of a revenue account. Now, of course, there's different types of revenues. This one, I'm going to call this services revenue for a nice generic term. So services revenue. Of $4,000. Then the next one, on the 9th of March, the company completed a $7,500 project for a client who must pay within 30 days. Now, because of the fact it's saying they're going to pay within 30 days, that right there implies a accounts receivable, because that's going to be not money right now, but it will be money coming. So instead of cash, I'm going to debit accounts receivable. For $7,500. And then the credit is also going to go to services revenue. $7,500. On the 12th of March, the company paid $4,200 cash to settle the account payable created on March 3rd. So we go back to March 3rd, and we did have an amount. Here it is right here. Accounts payable, $4,200, and then the company paid $4,200. So we don't owe on that accounts payable anymore. We've paid it off. So this is a credit balance on accounts payable. To get rid of the credit balance, you had to do a debit entry. So I'm going to debit accounts payable to clear it out, or to reduce it. Either way, same thing. And then the credit goes to cash. And since it's a credit to cash, that reduces cash. $4,200. Okay? On the 19th of March, the company paid $5,000 cash for the premium on a 12-month insurance policy. Again, we have a hint to debit prepaid insurance for $5,000. Okay, so we do that. We go ahead and take advantage of the hint, which is to do prepaid insurance. And just like with prepaid rent, we talked about that you own the right to occupy the premise, so you prepay it. And the same is true for prepaid insurance. You now own the right to be insured because you have paid for it up front. So now you own a 12-month policy. 12, and you can actually hold up the policy and say, this is a 12-month policy, I own it, it's mine, and so that makes it an asset. So prepaid insurance is a debit. For $5,000, and I paid cash for that. So credit cash, $5,000. On the 22nd of March, the company received $3,500 cash as partial payment for the work completed on March 9th. What happened on March 9th? Oh yeah, we did do some work for somebody for $7,500, and we created an account receivable. So accounts receivable, of course, means that we are going to get money from somebody. We have not gotten the cash yet, but we will get the cash. So on the 22nd of March, I did indeed receive $3,500 in cash. So I will debit cash for $3,500. And just like I did with accounts payable, I'm going to do this with accounts receivable. It is a debit balance. And if it's a debit, I need to reduce it. And how I do that is by making it a credit. So I credit accounts receivable to reduce that amount. Okay. I'm running out of paper here, so let me flip this over. Okie dokie. So here we are on the 25th of March. The company completed work for another client for $3,820 on credit. So if this is on credit, what does that imply? Accounts receivable. Yes, of course, because we did the work, we earned the money, we're going to get paid for it, but we haven't gotten paid for it just yet. The cash will come in a little bit later. Okay, so I'm going to create accounts receivable for this one. And that's for $3,820. And again, because this was work that was done, we're going to credit services revenue. Okay. On the 29th, Brooks withdrew $5,100 cash from the company for personal use. So this is a different type of account. This is not your typical expense account. This is actually a withdrawal account. So I'm going to debit cash withdraw